Hey there, Brian Bogner and Greg Towner with Parallel Financial, Parallel Portfolios, all of the above. And we're here for the 20-minute market breakdown for the month of February. We're now a month and a half into the new year here in 2023, and we've got a lot to talk about. Greg, how are things going?
Things are going great, Brian. I know it's still only mid-February, but it's been warm here in the Southeast. So, it feels like spring is almost in the air. I mean, I'm seeing some flowers pop up. Football is behind us now. So that means March Madness for basketball is coming. The Masters golf isn't too far. Spring training for baseball. I don't know. Spring just feels hopeful. So, feeling good.
Yeah, it does. It has been a little bit warmer, a little bit of rain and things like that. And, usually this time of year, what also happens is, we've made all these New Year's resolutions, right?
Yeah.
And we with our willpower and things like that, the month of January we tend to do well, and then life starts getting busy and things like that start getting in the way, and a lot of this stuff starts coming off the rails and falling apart. So one of the
Yeah.
things I've been doing, encourage folks, it's good to set goals, but it's better to set good systems in place to keep those goals. And it just means, this is the time of the year where, if you have a goal that you've set, well, then, I always say, let me look at your calendar. And does your calendar reflect the goals that you're setting? Are you committing the time each and every day to what it is that you're trying to accomplish? So I just encourage you that if you're hitting a wall or struggle something, get on that calendar, schedule some time, and just keep, just crawl, walk, run. If you just need to crawl for a while, crawl, stay at it, you'll get there. So yeah. All right. Well,
Good.
we've got a lot to talk about today, obviously, when it comes to the markets.
Yeah.
We're going to cover three things. We're going to give an update on inflation, our thoughts there, because that is probably first and foremost on everyone's mind, followed very shortly by, are we going to have a recession here in 23? And then, of course, what does all that mean for the stock market? So, Greg, what are your thoughts on inflation? What are some things you're seeing now?
Yeah, I know, this is something we and everybody else has talked about a ton, and, we'd prefer not to have to talk about it all the time, right? But the reality is it remains that the hottest topic and the most important topic for the market. And it's kind of mixed, So we're recording this on Wednesday, the 15th. Just yesterday, the Consumer Price Index came out with its latest data. The good news is it was the seventh consecutive month of year over year,
Mm-hmm.
slowing of inflation. So that's obviously a good sign. The negative is it was just slightly lower. In fact, it came in a little bit higher than expectations. So, it's coming down, it's moving in the right direction, but it seems to have kind of that decline has maybe stalled out. I mean, it's only 1 month, so we'll see. But you really kind of need to drill down a little bit. There's a lot of data in inflation. We're not going to go into all of it, but so for example, if you look at the goods and services elements, the goods, the actual products that are bought and so forth, that those numbers have come down nicely. I mean, we're actually back down to near historical numbers for inflation
Right.
there, 2% or so. But it's the services side, and this probably isn't a big surprise if you've been out to restaurants or
Right.
traveled. People are spending. But the biggest component of services, almost half of it, is shelter or rents. We've talked about how the government does a bad job of calculating that data. They look at old rents that are still in place, that maybe were signed 12 or 24 months ago, and use that data as opposed to new data coming in. So if you
Right.
look at like data from Zillow or something like that, real time, they're showing rents actually declining in price now. So maybe mid-year, maybe second half of this year, we'll get some of that data. But inflation is a little sticky here. We've said that we think it maybe ultimately settles at 3%, which is a historical norm. The Fed wants to get it all the way down to 2, which is where it's been the last decade. That seems a little unrealistic. Hopefully, they're just talking up that big game, and maybe they are okay with it settling around 3. Because if they are, determined to get it down to 2, that could cause some problems eventually.
Yeah. Well, we've been saying for a while, when inflation peaked back in mid 2022. I know, if you listen to our calls and things that we've done since then, that's what we've been saying. So it is, you're right, it is a little sticky, but it's moving in the right direction.
Right.
But the key in all this, of course, is, what is the Fed going to do
Hmm.
with this, right? And then that gets us into our next topic, which is recession, because the fear, right, is that the Fed is going to just keep it tight and keep pushing and keep raising rates and keep going. that they end up over tightening, and then we end up with a pretty bad issue.
Yeah, and of course, the difficulty with recession is predicting it. Everybody wants to predict when there will be one, there
Mhm.
won't be. It makes me think, of course, everybody watched the Super Bowl here just a few days ago, and I was watching it with my wife. And just before, we saw, or I was saying, well, I think maybe the Eagles might win. It should be a close game. She said, oh, maybe the Chiefs will win. So, we know who won and we know who's the smarter football person in my household, since she was right. But nonetheless, right before the game, they had all the experts on there. I don't know, 8, 10 of them. Every single one picked the Eagles to win.
Right.
And I thought, oh, from our investing world, we know
Right.
when everybody's on one side. And so it made me think back, just this past fall, there was a Bloomberg survey or economic model where they looked at all this different economic data and economics survey. 100% chance, they said, for a recession.
Yeah.
And if you look back at when that was, it was that October, which at that point was the absolute peak in inflation. It was the low in stocks. It was when sentiment was the worst. So all these things kind of aligned where everybody was predicting a recession. And now we're still early in the year. Obviously, we'll talk about how things may or may not play out. But the reality is things are actually picking up. If you look at the economic data, just this morning, retail sales number came in stronger than expected. The data is coming in strong. Obviously, the jobs data is incredibly strong. The headlines grabbed a little attention from the tech companies laying off, but the jobs data is incredibly strong.
Right.
We know if the U.S. consumer has a job, they spend, right? They spend.
Yeah. Well, I mean, not only do they have a job, but they have a job, then they're getting paid well.
Yeah.
It's not, I mean, it's not like what we saw over the last couple of years is wages across the board increase. Now, granted, inflation was also there with it, pushing it as well. But yeah, they are spending. I know we talk about this a lot that, yeah, have there been some layoffs? Absolutely. Have there been some corrections in small corrections regionally and maybe in some real estate or some other areas and things like that? Absolutely. But is this really just a return to a normal, like, instead of like we were just doing amazing and then, oh, this thing's falling off the cliff? No, we really weren't doing amazing. It was actually getting a little heated or what. And now we're just coming back to the long-term growth averages.
Yeah, exactly. And what we're seeing is, consumer confidence is actually on the rise. Small business confidence is on the rise.
Right.
What we're seeing from the negative side, as far as comments, you see some business owners or even CEOs of big corporations, and I know you can talk to this with all the business owners you speak with, but they're seeing good things with their business, but they're worried because they're hearing all the noise out there. They're hearing, oh, there's going to be recession, and so they're like, well, we're cautious, but we're not seeing any problems, right?
Yeah, I mean, I talk to a lot of, again, small business owners here in the area, and they all say the same thing, like, hey, I've got, I'm booked out, or I've got orders into 24 or into 23 or this or that or that. My biggest challenge is I'm still trying to hire people. I'm still trying to get folks in to do the things that we need to do, and we're just slammed, and we're going crazy right now. And that just doesn't sound like to me like, okay, there's a recession on the horizon here about to hit.
Right. And then moving on to another huge aspect of the economy is housing. I mean, it like a lot of things got ahead of itself, no question.
Right.
The rates went up, it kind of froze the market, and it's still somewhat frozen. But the inventory is so tight. There are so many people that still want to get into housing that it seems like that market is maybe bottomed.
Yeah, I mean, the other thing you're seeing too, I think the Wall Street Journal had an article, I don't know, this week on it, but and I've even heard some agencies around here talk about it. I mean, I think there's a lot of real estate agents leaving the industry now, but again, over the last few years, I felt like every other person I knew got their real estate license and was going to go sell real estate. So, again, I think we're just getting back to some normal levels. And I mean, we say this a lot, you have to be careful, right? We don't want to keep you watch the news, you watch the headlines, you watch these things, and you can let them, I mean, you can end up being like a puppet, and they just start pulling strings on you, and you start thinking a certain way, and like, oh my gosh, the news is not designed to make you informed and knowledgeable about what's going
Right.
on. The news is designed to entertain and get clicks and
Yeah.
sensationalize things.
Yeah. Yeah, I mean, at the end of the day, I mean, recessions, they're normal. They happen. I mean, we're not
Right.
going to put
Right.
one off forever. I mean, what was it? I think Australia didn't have one for like 20 something years or something. Well,
Right.
that's just
Right.
unrealistic. I mean,
Right.
it comes back to, and you alluded to it earlier, how far will the Fed go? You know,
Right.
will they keep pushing too far to reduce inflation because they
Mm-hmm.
see the economy strong, they see the
Yeah.
jobs market strong? If they keep going too far, then they might, create a recession ultimately.
Right. Right.
But my hope is that they'll kind of pause here after another meeting or two because everybody, is under the assumption that the lagging effect, all the rates that they've done take a little
Mm-hmm.
while to work their way through the system. So I'm hoping they'll pause here soon.
Yeah. Well, then everything we've talked about at this point, let's get back to, I mean, ultimately, right? We're investors, we're investing money. So what does this
Yeah.
mean? Let's talk about the stock market here. What does it mean for that? These two things, inflation and recession.
Yeah, I mean, going back to, stocks, bottomed, at least put in a notable bottom in October. We mentioned that was when, pessimism was at its worst, inflation was at its peak. All those economists were calling for a recession. So maybe the market, with that correction it had last year, was already, factoring in that potential recession. So that
Right.
if it does come, maybe it's factored in. Or what if it doesn't come? Even better.
Right.
The market looks ahead. We all know that.
Mm-hmm.
And maybe it was looking ahead and assuming, like everyone else, that things were going to get really bad. And at least thus far, it hasn't. So maybe that's factored in. The tone has changed in the market now. You're a little bit less talk about the inevitable or the immediate recession. They're shifting to, well, corporate earnings are coming down now. Things gotten too far ahead of themselves, which is probably true. So now we're going to have earnings coming down, and that's going to be the next leg to fall. Well, I mean, that's getting factored in already. The numbers have come down,
Right.
but what we're seeing from corporations, it's been pretty modest. They're raising prices. Of course, we know that. They're cutting some costs. The corporations, particularly the large ones, have gotten really efficient over years. So we think from a fundamental standpoint, they're going to be able to keep their earnings reasonably solid unless
Right.
things get really bad.
Yeah, I think the most important thing right now, I think I said this to you yesterday. Like when we talk about the markets, like we're in a wait and
Mhm.
see kind
Yeah.
of thing. And sometimes I feel like 90% of the time we're in a little bit of a wait and see, and let's see what's going on here in the market. Like, we have felt that the market, right, will be range bound for a while. Like this isn't like, oh, we got through last year and we're off to the races now. There still are some headwinds out there and things like that. But the idea that I think we're conditioned like, oh, we have a recession or these things are happening. Well, that means we're going to be in a bear market and the market's going to drop
Right.
down another 20, 30%. And
Yeah.
I got to go to cash and all these other things. And it's like, no, there's a lot of different ways that the market can react to some of these things that are happening. And it's important to have a very open mind right now and to not to come in and evaluate things with already some what's the word I'm trying to get here, like already have a view in mind, right? Already have
Right.
an
Right.
opinion. Take that off the shelf and just really look at what is happening, what's going on here, and let's evaluate these things. I mean, again, we believe the market is going to be somewhat range bound, and so you'll see moves, significant moves up and down. And we also believe that what worked for the last 10 years is not going to work for the next 10 years. And so, again, there's headlines coming out right now with certain hot stocks that have been popping, and all this stuff. And people are, oh, okay,
Right.
they're back and this and that and this and that. And we're not convinced. Okay.
Yeah.
We think that the whole environment has changed. So, take a step back and let's see, let's look at all the pieces on the table, all the stuff, and just see what really is taking place here. And I think that's a really important view to have right now.
No, I absolutely agree. I mean, a lot of people get caught up in all of that and they tend to avoid some actual data. And that's why not
Mhm.
only are we big believers in the fundamental analysis, but also the technical side of things. And some of the technical trends are actually improving here, kind of
Right.
defying
Right.
what people are looking at. We talked about on another recent video that what's called the golden cross, the
Right.
50-day moving average of the S&P moving up above the 200-day. And like any signal, it's no guarantee, but the
Mm-hmm.
returns during that period are much better than the opposite. And so, you mentioned trying to stay open-minded. I mean, that's something we've been talking about since I think maybe last summer. There's also, another comment that I thought was really interesting. One of our favorite market strategists, Jeff DeGraff, he says, be imaginative.
Mm.
And I think what he's alluding to is what you were basically alluding to yourself is, everybody's just assuming this bad outcome is going to
Mm-hmm.
occur, whether it be the CEOs or investment professionals or so forth. Don't make those kind of assumptions. Stay
Mm.
open-minded to them,
Right.
but also stay open-minded to a better than expected outcome.
Right.
And
Right.
that always reminds me of a quote from one of my favorite investors, one of the greatest investors of all time, Peter
Mm-hmm.
Lynch.
Mm-hmm.
And he said, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves.
Yeah.
And to me, he wasn't necessarily, a technical analyst per se, but to me, that's the emotional side of things in description right there.
Yeah, absolutely. I think you nailed it. You nailed it on the head right there. And I think that's probably a good place to bring this this episode to a close. Again, sometimes I feel like we do repeat ourselves a lot, but it's just important because it's what we believe is just be careful what you're watching and what you're reading and what you're seeing out there. Yeah, that's a good quote right there to live by for sure. Well, let's go ahead and let's wrap this up for today. We always like to end this with some recommendations that we have here, Greg. So I'll let you go first. What do you got for us?
Yeah, a couple things. Let's start with the non-investment related. Well, this coming weekend is the NBA All-Star Game, the basketball All-Star Game. I think I'm a big basketball fan.
Mm-hmm.
I know you're a fan. I know your son's a huge fan.
Oh yeah.
A lot of these All-Star games are really just for show and entertainment, and that's fine. And the basketball is basically just a bunch of guys running around dunking, and it's not all that great for some people. But I would tell people, if you're a basketball fan, try to tune in for the fourth quarter, because when these games happen to be close, which isn't always, but when they are, these greatest athletes, greatest basketball players in the world take it seriously, and they want to beat the guys across from them. And it gets really interesting to see these incredible all-star players go head to head and really try. So hopefully we get a close game. At least tune in for the fourth quarter this weekend.
Okay.
The other thing on the investment side, I know we've talked quite a bit in recent months about dollar cost averaging. It's not the most exciting topic, but you mentioned how we think the market is going to probably stay in this wide trading range for a while. To me, that's an opportune time to do dollar cost averaging.
Mm-hmm.
But more importantly, one thing that we haven't really touched on a lot is, people, when they have all this cash on the sidelines, they're worried, oh, I want to pick the bottom. But then when the market sells off, they're afraid things are too bad.
Right.
If the market goes too high, oh, I've missed it. I can't do it now. So again, back to the behavioral side of things, just put money in every month, every quarter, every paycheck, whatever works for you. Dollar cost average, it will take so much of the emotion out of it.
Absolutely. And that leads into my recommendation here in terms of getting the emotion out of it. I'm going to make a promotion here. Many of you know, or maybe you don't know, this may be showing up backwards. I don't know as I lift this in, but Greg wrote a book back in 2020, and it's called Investment Lessons of 2020, How an Unprecedented Year Taught Us Everything About Investing. And a lot of things that we talk about on this podcast and we go through is in this book. Now watch, I'm going to turn this book sideways. If you're viewing, look how thin this is. Okay. This is not like a heavy textbook read or anything like that. Okay. It's a great read. It's a great book. It's free to our friends and clients here at Parallel. So if you would like a copy and you don't have one, shoot us an email, give us a call, and we'd be happy to send one your way. We're always here to help. We're always here to answer any questions that you have, whether it's for you or your friends, family. So by all means, please keep us in mind and please let us know if you have any questions. But thanks so much for listening to our February 20-minute market breakdown, and we will talk to you next month.